space. Pratik Gupta is CEO and co-head Kotak Institutional Equities. He's with us now. Pratik, good morning. Good to have you back on the program. Thanks for your time. Just a quick word on all this excitement around China. And the question is this time different? More importantly for our viewers here, there are two implications. One is metals, as Nigel was also pointing out. So maybe a bit of a lift for commodities in general if there is more actual real fiscal stimulus in China. And second, of course, is flows. Most flows into India comes from emerging market funds. There's one argument that if China will take away money, it won't come to India. Does that really hold water? Because if flows start to come into EMs, it'll come according to different weights, and it'll come to India if it comes to China as well. So just your quick word.
Yeah, good morning, Prashant. I think as you rightly pointed out, when you start seeing China running up, that does have a positive rub-off impact on India as well because of the overall weightage it has in the EM indices. Just to give you some numbers, China in the last 1 week alone has rallied by about 12 to 13%. India has also gone up, but definitely not by the same extent. So India is also seeing a lot of foreign inflows in the last 15, 20 days, but not as much as what China is seeing. And when we speak to global investors around the world, emerging market investors, their unanimous view is China is cheap, India is expensive. Having said that, until recently, they were unwilling to put more capital into China because of concerns about the regulatory uncertainty, weak earnings growth. So it is a cheap stock, a cheap market, but expected to stay cheap. Now, this week, obviously, we've seen the Chinese government put in a lot of stimulus. They've cut the reserve ratios, more lending prospects, and so on, recapitalizing banks. All of that is quite positive for the Chinese economy in the short term. And that's why you're seeing this big run-up in China, and India is benefiting from the overall flows into EMs. But I think the bigger picture, longer-term picture still remains that most global investors are still wary of China, especially if you have, let's say, someone like a Trump who comes in as the US president. He could impose pretty aggressive tariffs on Chinese exports to the US. So therefore, this is more of a trading rally. Most global investors don't see it as a sustainable rally in the long term, although in the short term, obviously, there is some money going into China. India is getting its share, but we are still seen as a very expensive market. We're trading at 23 times one-year forward earnings. We're trading at a 90% premium to the MSCI EM index. So in that context, we will get our share of flows, but they'll be a bit muted, not like what China is getting.
Fair point, Pratik, but I guess that hasn't stopped our market from running ahead, right? Because you've got so much of domestic liquidity that continues to power stocks. And that's a month-on-month story. So let's talk about the here and now. The only difference is while the money is coming in, the difference is that now it seems to be coming in different parts of the market. We've seen some rotation into IT. We've seen some money move back to financials. And of course, metals being this tactical trade like you described. In terms of portfolio positioning, have you made any changes in the last month or two? And what would be your key overweights now?
So I think you can look at it from a different perspective as far as the portfolio is concerned. First is we have been advocating for the last few months to reduce weightage in small caps where we thought valuations are getting aggressive. Likewise, in many mid caps as well, and shift to large caps. And that view hasn't changed. Second, we've had the view, for example, some of the sectors in the market were getting overheated, defense, chemicals, some of the PSU stocks, and we've seen a correction over there, but we think it's still not enough. These segments still overvalued. Conversely, some of the underperforming sectors is where we are somewhat positive on. For example, the private banks, the life insurance companies, the telecom companies. And then there are sectors where we still like them. We think the earnings growth prospects are still good. These are no longer cheap, but we think in the absence of alternatives, we would still like the real estate companies, the hotels, the hospital chains, and so on. So we made in terms of recommendations, a bit of a shift, but overall, we're still somewhat staying away from the small mid caps, moving to large caps, and moving away. Still recommending investors to move away from defense and PSUs and go to the banks, life insurance companies, and so on.
Right, no, absolutely. And I think point taken. By the way, this consensus kind of view, Pratik, that large caps will do, I mean, it's been there for a while, right? I mean, tilt towards large caps. Is that now finally starting? Is it possible that we see actually if foreign flows come, is it possible large caps do very well? I mean, very well in a quick time span, whereas the broader market sort of lags a little bit. I mean, seriously lags a little bit. I'm talking about from here, say, to the end of the year. What's your sense?
Absolutely, Prashant. That, I think, is our view. We think also, if you look at the small mid-cap rally, this is driven mainly by very strong local flows. Local flows are still very strong, but if you look incrementally, most of the mutual fund inflows are now going into large cap schemes or balanced fund schemes. They're becoming a little bit risk averse. They're no longer coming into the small cap or mid cap portfolio as much as they were perhaps, let's say, 6 months ago. And meanwhile, if you look at the foreign flows, they are typically always far more large cap oriented. Typically, when you speak to most of these FIIs across the world, whether they're sovereign funds or hedge funds or long-only funds, they don't really have coverage or earnings models or a very deep understanding of some of these small and mid caps. You'll have some India-dedicated FIIs who have that, but that's a very small part of the overall foreign flow. The other part of the foreign flow is also the index-related passive money. That does come into some small mid caps, which are part of the index. But by and large, bulk of the foreign flow will come into the large caps. Valuations for the large caps are relatively more attractive. Like I said, this is on a relative basis. Nifty's at a 23 times, but the small mid-cap indices are even more expensive. So if you look at the valuations, you look at the price performance, you look at the flow outlook, and you look at the earnings outlook as well, most of the large caps, they're very well capitalized, strong balance sheets, have underperformed. Valuations are attractive, earnings prospects are good. So we think they should do quite well. As you rightly said, they could quite dramatically outperform the small mid caps in the next 6 to 9 months.
Hi, Pratik. Good morning and good to see you, Win. What about the capital marketplace? There's been a lot of excitement out there. But if the market's going to a phase of consolidation, a bit of a lull, then maybe, you'll see some kind of pressure out here. And mind you, these stocks have gone up double, triple as well. NSE in the unlisted market in the last 1 year is doubled, and people are still wondering whether it gets listed or not. How do you approach this theme? It's played out well, but what would you do?
I think time to be cautious on the capital marketplace. This is not to say that from a very long-term perspective, 3 to 5 year, 10-year perspective, these stocks will not do well. The business outlook is very strong. The potential for further capital market penetration is still, the number of demat accounts, broking accounts, the AUMs of the mutual funds. These can grow quite substantially over the next 5-10 years. So from a 5-year, 10-year view, these stocks still look very good. But from a, let's say, 6-month, 12-month view, it is time to be a bit cautious. These stocks have gone up very much. Valuations are very expensive. There could be some regulatory changes coming, which could impact the earnings of these businesses. You have something perhaps coming from the regulators have already been cautioning, for example, the exuberance and the excessive retail speculation in the options market. So any regulatory action against that would impact many of these companies. And then obviously valuations and the whole capital market cycle. We are in a very buoyant capital market cycle. This can carry on for some more time. But at this time, usually as you get closer to the top, the multiples should contract. We are still trading at very, very aggressive multiples. So short term, somewhat cautious. On a 5-10 year view, I think we're still quite positive.
By the way, Pratik, what is the rate of new initiations at Kotak? Has it picked up over the last couple of months?
Oh, yes, of course, it has. We're now covering more than 300 companies. Partly it's because of a lot of the IPOs that are happening, which we have been leading. But also our analysts are initiating on a lot of interesting companies, which were earlier, we knew these were good companies, but they were just too small for many institutional investors. We cater to institutional investors. And typically our market cap cutoff is at least $1 billion, if not more. And some of these stocks, these companies have become big. These stocks have become much bigger in terms of market cap. So now we can cover them. Our investors find enough liquidity in them. So we are increasing coverage both because of the secondary market sort of opportunities, and also because of the IPOs which are coming through. So we're now covering close to, or I think almost 300 stocks, which is probably amongst the largest in India.
And if markets continue to go like this, maybe another 300, not very. I don't know how many. Do you at the top of your mind? How many billion-dollar plus companies we have, market cap?
I think it would be at least north of 400 now. At least 350, 400, my guess.
400. Okay, got it. And you covered 300. So
Yeah.
got that. Pratik, great conversation. Thank you very much for joining us. Appreciate it as always here on CNBC TV 18. Well.